Right to the floor show. Joining me now, Crossmark Global Investments CEO and CIO, Bob Dahl. Happy Friday, Bob. Nobody wants to go long here.
Here, here. Oh, it's been how many weeks in a row of long, Liz? Take a little off the table.
Yeah.
I think it's just fine. Earnings have been just off the charts.
They have. But, with today's losses, the blue chips are now on pace for their first weekly loss in 3. Not by much, just 0.5% for the week. S&P still clinging to 1/3% week-to-date gain. Kind of small, but we'll take it. NASDAQ flat. We'll see if it can hold, at least to that. But you're becoming increasingly concerned about going high risk in what you say is already a high-risk bull market. What's got you moving in that direction? Even as you just mentioned, earnings are just gangbusters here.
Yeah, earnings have covered up a lot of sins. The sins are what's going to happen in the Middle East. We don't know what's going to happen. You just covered it with the price of oil. Is inflation the problem that many of us think it is? How high will interest rates out the curve go as a result of all that? It wouldn't matter if stocks were selling at 15 or 16 times earnings, but at 20, admittedly down from 22, 23, as earnings have gone up so much faster in the stock market, so the valuation level has come down. But they're among the things that keep me up at night, despite the amazing flood of earnings.
What about what some say is over concentration in the AI names? Why does that make you concerned?
It's how much money has gone into them. How much some of the valuation levels are where they are. You covered that with the Avco a second ago. How are people going to react if the earnings don't continue to be 100% better than expected?
Well, again, earnings growth is extraordinary. Do you think it's poised to slow?
Well, inevitably, it has to slow at some point, Liz. But the expectations, as you know, as earnings have come in, the expectations just keep going up, which just takes the what's incumbent upon stocks to do to be more and more difficult as they climb that amazing mountain of earnings. And, when you see earnings for the quarter up more than 30%, technology earnings up 50%, how sustainable is all that good stuff?
We're going to get to your picks in a second, but before we do, I'm holding up this report from Fitch Ratings, and that came out this week. And basically, Fitch is saying that we continue to see that defaults, private credit July defaults, are hitting a record high. What I found interesting as I dug into this report is that it's not software stocks. It's more like consumer products and services sectors that are defaulting on these loans that they're taking. But is there anything here that makes you look at and say, oh, maybe software isn't the worst picture in the world, but we still got to be careful about private credit?
No question. I could have put that or should have put that on my list. Those credit problems
I got you, Bob,
are
don't
moving
worry.
up, but credit spreads remain, as you know, very tight, Liz. Until they create problems, I'm just going to keep it on a back burner as a problem.
Okay, back burner. You say it's not something where you look at some of the bigger names, although they are selling off today, who are in private credit. We're talking about Ares and KKR, the Carlyle Group, Blue Owl. Again, they're all down 3-4% right now. I wonder why.
After the last couple days, doing really well.
Okay, good point. Good point. See, that's why you're here, Bob. Let's just quickly talk about rates. The data are coming in slightly weaker lately. So today that just happens to not be good news, but usually it is. And you have a lot of investors who look at weaker consumer data and econo data and think, oh, good, that means the Fed won't hike rates. But if the Fed were to hike rates, because there's still a possibility that we see one by December at least, small tightening, how would that affect these tech stocks which have been borrowing a lot of money?
I don't think the stock market as a whole and those high duration tech stocks would like higher interest rates one bit. They've kind of looked the other way as rates out the curve have moved up quite a bit, but they're watching the Fed carefully. Can they do one increase and not hurt the stock market? Not so sure.
I'm looking at the 30-year 6-month. I think we blew through the 10-year 6-month. Important to note that the 6-month 10-year intraday yield, 3.96 back in last March. So, or March, yeah. So today we've got it at 4.698. These rates are kind of going in the wrong direction. And depending on how you look at it, 30-year I guess in the last 6 months, that was at a 4.63% low. We've got it now at more than 5.26%.
And go back to the pandemic. Both those rates were under 1%. So rates on the 10 and the 30-year have moved from under 100 basis points to where they are today. Slow but steady bear market for bonds as government borrowing, as inflation, as easier credit. All of these things have caused interest rates to move higher.
Bob, give us your three names that you do like no matter what.
Yeah, I picked three very different from one another.
Yeah.
Fortinet, FTI, is obviously a high multiple, high expectation stock. It's cybersecurity. My view, Liz, is cybersecurity is becoming more and more important. AI only complicates the need for cybersecurity, so I want to own it. I picked an energy name. Nobody knows nothing about energy. One wag says, and I think you need some in your portfolio. Why this one? Lower break-even point, good cash flow, lots of oars in the lots of different waters. And finally, I wanted to pick a financial name, so I picked Citi, any of the big banks. Look, when the big banks are on the new high list, and almost all of the big ones are, that's rarely a time when the market gets in trouble. So watch them very carefully.
Okay. We got listeners on XM113 in their cars. You said the energy name, but you didn't say the name. It's ConocoPhillips that you like, ticker symbol CLP.
Apologies.
No
CLP,
worries.
yes.
No worries. I just want to have everybody's backs here. Bob, wonderful to see you. Thank you so much.
Have a good one.